Welcome everyone to this panel organized by the economics department on the events of the last couple of weeks in the financial markets. And I suppose, we've all been lost for superlatives. I mean, it's been, historic, momentous, an earthquake, and it's been really breathless, actually. So every day there's something happening. And even as an observer, it's just a really exhausting experience just to follow. I mean, it's like, watching a Jackie Chan movie where you've just seen this hugely elaborate action sequence, and you think, phew, I need a rest. But then he goes on again, and then there's another action sequence, and it's even more outrageous. And it's been going on like this for the last 2 weeks. So, we have sort of pretty, lively discussions over lunch, and we thought it'd be good to share some of that conversation with you. So this is so think of this more as a debate among economists. And before I introduce our distinguished panel, let me just give you a bit of background to why we've actually reached this point. And I think one of the things one can look at is the weight given to the broker-dealer sector in the U.S. economies. And this is a sector that includes the major investment banks. And this is a series that goes back to 1952. So what I've done here is to normalize all the series so that the figures are all set at 1 in 1952, and just followed how large these sectors have become. And you can see that there are 4 sectors here. There's the non-financial corporate sector. So this is your retail, manufacturing, and other firms. Here's the household sector. And here are the commercial banks, and you can see that these 3 series have really sort of moved pretty much in unison, whereas the broker-dealer sector has just grown at a much, much faster pace. Now, you lose a lot of the detail here, but so, this is the log scale. So look at the scaling here. This is in log scale. You can see that what happens is that around about 1980, the broker-dealer sector just takes off. And you can see that it's now, about 10 times as large as it was in 1980 relative to the other sectors. Now, why did this happen? Of course, what's behind all this is the way that we hold home mortgages. And, this is a great transformation of the U.S. financial system. It's actually been spreading its model to the rest of the world. And, this is a chart that many of you have seen. Those of you who were in my corporate finance class in the spring, you will have seen this. So these are the holdings of U.S. home mortgages by different classes of financial institutions. And you see that even as early as the 1980s, the savings institutions, this green line, the banks, conventional banks, were the largest holders of mortgages. And then what happens is that the GSE mortgage pools, the government-sponsored enterprise mortgage pools, this is Fannie Mae and Freddie Mac, that just takes off. And then another thing happens somewhat later, around about 2002, 2003, which is the ABS issues. These are the asset-backed security issues. Think of these entities as the counterparts, the subprime, and the Alt-A and the jumbo mortgage securitizations. And that really increases very dramatically to overtaking the commercial bank series. So if you add the market-based system, which is the GSEs, the GSE mortgage pools, and the private label mortgage pools, and call them the market-based holders of mortgages, and then have everything else as the bank-based, you can see that in the early 80s, the bank-based have dominated the holding of mortgages. But then it got overtaken around about 1990, and now it's 2/3 of the weight of the whole market. So if you like, this is what's behind the very rapid increase in the broker-dealer sector. And it's a sort of symbol of the market-based financial system that we have, where capital market developments and the traditional banks are really now inextricably linked. So we can see this also in the balance sheet of the institutions that have been in the news recently. So here's Lehman Brothers' balance sheet as of the end of last year. And it's a balance sheet that looks extremely short-term, very liquid, and very fragile. So let's look at the liabilities. How does Lehman, or how did Lehman fund its operations? Well, the 3 biggest items, 3 of the biggest items are short positions. That's when you go out and sell securities you don't own, and then incur the liabilities of those short positions. Collateralized borrowing. So you go out and pledge securities, and then borrow money against that, and then payables. These are the hedge fund deposits. So when you're operating as a prime broker to a hedge fund, the hedge fund will be depositing money in your account, and this is the hedge fund account here. So none of these things are actually what you might call very, very stable. So if there's a run, So this is hardly, you know, Bailey's savings and loans, but if there's a run, it's going to be extremely, you know, rapid, you know, withdrawal of funding here. The only sort of stable bits are, if you like, the long-term debt and the equity, and that's only about 1/5. And here's Bear Stearns, very similar. The payable section, of course, is larger because Bear Stearns was a much bigger prime broker to the, you know, to the hedge funds here. And of course, what this has meant is that, you know, their behavior has been dictated by market conditions. And so when, you know, measured risks are low, and, you know, when asset prices are rising, and when financial conditions seem very, you know, very good, and, you know, as far as you can see, you know, it's clear skies, and, you know, it's just, you know, sort of very, very smooth road to very high profits, then you actually, you know, increase your leverage. You expand your balance sheet size. Whereas, you know, when things get tough and your measured risks go up, you do the opposite. And what we see this, and what we see is that for these investment banks, the behavior between leverage and balance sheet size is actually positively related. So it's when your leverage is, it's when your balance sheet is really large that you lever up. And that's exactly the opposite of what you would expect from a household. So, you know, if I've bought a house with a mortgage, when my house price goes up, my leverage comes down. My balance sheet becomes stronger. It's exactly the opposite for these market-based financial institutions. And here's the weighted average of those. And, you know, this was the weighted average of the then 5. And how many do we have now? Well, 0, because the last 2 remaining became bank holding companies as of yesterday. You know, they're now under the protection of the Fed's bank supervision umbrella. So here's what can happen. This is the holding of cash by Bear Stearns in the last 3 weeks before it was taken over by JP Morgan. So, you know, it's about $15 to $20 billion of cash until 3 days before the run, and then there's a run, and then you're left with $2 billion. And this is a very, you know, this is you know, sort of the Bailey savings and loans on steroids. This is sort of, you know, this is a really, really very, very fierce run, and it's a fierce run because the creditors are, of course, very, very sophisticated. They're not going to hang around and wait for the rumors before they actually run to the bank. They're actually running, you know, trying to get there ahead of everyone else. And here's, of course, AIG. Now, why would you rescue an insurance company of all things? You know, this is not even a bank. Well, with AIG, you know, I think the key is that their holding company, which is this thing in the middle, and there are all their insurance subsidiaries. And this is why, you know, had AIG not been bailed out, there would have been something much, much worse happening in the financial markets, you know, relative to what happened after Lehman. AIG, of course, was writing all these insurance contracts for these financial claims. And, you know, it was the AIG's insurance backing that actually enabled these other financial institutions to borrow at a much more favorable rate. Had AIG gone bust, then all these institutions would have had to put up a lot more collateral. That would have led to a much fiercer run, if you like. And so that's the background. And what we'll do is to use our comparative advantage, you know, our respective comparative advantages. And we'll begin with Markus Brunnermeier at the end, and he's going to tell us what actually happened last week. You know, it's sort of bewildering to many people who are not in this field. What on earth happened? And Markus will tell you exactly what on earth happened in 10 minutes. And Harrison Hong is going to tell us about the route that we actually got there. So how did we actually get there? So what actually allowed this to happen, and what actually was motivating these institutions? And then Paul Krugman is going to tell us about, you know, what should be done. And, you know, I'm sure you've read his views already, so I'm sure we'll see a reprise of some of them. And I'm sure you'll know that Alan Blinder's views are somewhat different. And so Alan's going to tell us where we go from here. And just in case, you know, it gets a little bit out of hand, I have, you know, something to stop it becoming, you know, too hot. So, with that, let me hand it over to Markus.
So I will just continue where Hyun stopped. And I won't tell you exactly what happened last week because you still need some time to digest this. Let me just make sure that, okay. What I want to say more is what are the challenges, what happened, what can we learn from this, what went wrong, and how can we improve the financial architecture we are facing. And I want to come back to the mechanisms which are behind this, and these mechanisms will help us to understand what happened last week and during the last year in general. I think as Hyun alluded to, what's really important is to look at the broker-dealer sector. You have to look at the investment banks in particular, but in more general, even in the macroeconomic perspective, it is the case there's a huge challenge out there, and this challenge is called maturity mismatch. Okay, you always have these long-term assets which have a maturity of 10 years in mortgages, firm loans, and so forth, which have to be financed, and they're mostly financed with short-term funds, with commercial paper, CP, which have a duration of 3 months, and increasingly, especially for these broker-dealers, through repo markets. And the repo markets, a big chunk of it is just overnight. So you have to refinance it every day overnight. And that's not only true for the broker-dealers, that's also true for all the new financial innovations, for all the structured products. For the SIVs and all this, they work the same way. You try to finance some very long-term assets with very short-term funding. So why do you do this? And the reason why you do this is because financing it long-term is very expensive. Financing it short-term is very cheap. There are money market funds out there. They have $3 trillion there. There are firms, savings, $1 trillion. So there's a lot of cheap financing out there, which is very short-termistic. And why is there this short-termistic financing? Because everybody thinks if I lend you short-term, I'm the first one to get out before the bank goes under. Okay? If I would lend it to you long-term, it would be much more risky. So there's this rat race going on. In equilibrium, it will be the case. There's a lot of short-term lending going on. Of course, there's also low inflation risk, and there's some argument you can incentivize CEOs by having the short-term lending, because if they do something wrong, you withdraw the funding. But short-term lending is much, much cheaper. And in addition, of course, the Fed kept the short-term rate low. So what happened is the short-term funding expanded and expanded. The whole balance sheet expanded, especially the short-term funding expanded. And what happens is you have to roll over the short-term funding every day. And if you look at the next slide, you see that what I have plotted here is the repo financing. What you can see here from 2003 onwards, so here that's, stay close to the mic, let me just, what's going on here, the repo financing, which is overnight, it takes about 1/4 of the balance sheet for the broker-dealers. So investment banks have to roll over 1/4 of their balance sheet every night. Okay? And if something goes wrong, it goes very quick. Okay? Because it's just a huge number to roll over. It's very, very risky, this rollover risk. And when the crisis hits, then, for example, subprime crisis, then the equity is gone. Short-term funding is much more difficult to obtain. Volatility goes up, haircuts are going up, margins are going up, and you can't roll over your short-term debt anymore. And you have to sell your assets at fire sale prices. Why at fire sale prices? Because your assets have very low market liquidity. You try to get some funding liquidity, but your market liquidity is very, very low. Essentially, you end up in a spiral. There are 2 liquidity spirals active at this point. A loss spiral, you make losses, and you have to raise more, you have to sell even more, and a margin haircut spiral, where at that time, because volatility shoots up, your margins are shooting up as well. So you have to come up with more collateral value at that time. And that's why you have to delever. And that's what's going on. That's very powerful, and this maturity mismatch is the underlying cause behind this. And there's no easy way to get around it. That's just, as in traditional banking model, that's the case, but it's something which challenges the whole system. So what was the problem? The problem is that the existing banking regulation is focusing primarily on capital ratios and leverage ratios. There should be much more a shift towards maturity mismatch. It matters a lot whether the repo is financed over 30 days or just overnight. Because if you have more time to find some new funding sources, it's much more stable. If everything is just done overnight, it's very, very fragile. And of course, you also have to take the market liquidity of the assets into account. But overall, the tension of the maturity mismatch will not go away, but there's a way to regulate this. The second problem is that the market illiquidity, the fire sale price, depends also on the maturity structure of the other investment banks. So if you're an individual investment bank, it depends very much what maturity structure the others are choosing. So there's an externality. If I choose my maturity structure, I don't take into account that I will affect others as well. And our risk measures and what we use for regulation, they only focus on the value at risk, for example, on the particular risk I am creating, I am having. I don't take into account for regulatory purposes how the value at risk will affect others. So we need new risk measures which takes these externalities into account, and one risk measure is the co-VaR instead of the VaR, which takes these externalities aspects and risk spillovers into account. The next point I wanted, so I have a whole laundry list of things and I can only focus on a few of it. The next point, in order to really understand last week, is very important to understand counterparty credit risk. Okay, and there are two ways to get around this counterparty credit risk. So that's an example, this is the CDS example. There are 4 investment banks here. Unfortunately, there are not 4 left yet, but at that time there were still 4, or even more. I have here a contract, let's say a CDS contract. Essentially, each bank knows only the contract it has with another bank, but it can net out everything. If you would know the whole system, everybody has 0 exposure. There's 0 exposure for the whole system. But because each bank only knows its own exposure, they are afraid of counterparty credit risk. If you have a clearinghouse, if the CDS contracts are not traded over the counter, but through a clearinghouse, you see these exposures, you could net it out. Okay? There was a huge resistance on Wall Street to move CDS trading onto a clearinghouse exchange system. Now there's the efforts underway. The other thing is you can reduce the counterparty credit risk by doing this. The next thing is, that's particular what happened last week. What happens is the banks got concerned about the counterparty credit risk such that they bought insurance against each other. So Merrill Lynch bought CDS protection against Goldman, and Goldman bought CDS protection against Merrill Lynch and so forth. Okay? So what happened is the credit spreads, the CDS spreads, that's how much you have to pay for this insurance, they really exploded. You can see these are the difference. Normally they're very low down here. They really went up here. The scale is misleading because AIG went through the roof. Okay? But having a CDS premium of 500 implies a default probability of 40%. Okay? So what happened is CDS spreads went up because investment banks tried to protect themselves from each other, and then rating agencies used the CDS spreads, observing them, and downgraded the thing. So there was a feedback cycle which fed on itself, hurting the banks even more, and then the CDS spread, of course, went up even further. So there are all these amplifiers at work which makes the whole system worse. So the problem is how credit ratings use the CDS spreads in getting the rating agencies out, how to rate banks. And this has to be taken in the future into account. So if you look at this chart, I call it reflecting mountain range, because essentially what it shows the 4 waves of the crisis. So what I split here, it's the top, the dark area, you can see the LIBOR, that's the rate at which banks lend to each other, unsecured, minus the OIS, the overnight index swap rate, that's essentially a rate which has no liquidity risk and no credit risk. You can see the difference, how it fluctuates around. You can also see how recently it jumped up. The red area, if you take the dark area and the red area together, you have the so-called TED spread. Okay? So the TED spread, the lower red area, actually, it takes also into account that treasuries are special. They're very special because they serve as a collateral. Whenever you want to borrow some money, the best collateral you can give somebody are treasuries. So the red area indicates the specialness of these collaterals, or of treasuries as a collateral. You can also see this in other spreads, which I don't have time to get into this. But one thing you should notice here is that whenever the TED spread widens, it's always close to the end of a quarter. Okay, there's an end of the quarter effect. It's surprising that it always appears end of the quarter, the TED spread is much, much wider, a little bit 2-3 weeks before the end of the quarter. There's some trading going on where people want to window dress to achieve certain reporting. They have to report end of the quarter. So that's a problem. causing this widening of the TED spread. So the question is, why do we require banks and other traders to report at the end of the quarter some snapshot? Perhaps it's better to let them report an average, so we get away from this end of quarter effects. So let me conclude. I think there are many little things which can make huge differences, how an exchange is arranged, but the big difference, I think the big important aspect is this maturity mismatch, and there has to be much more emphasis in future regulation on this maturity mismatch. Of course, also taking the market illiquidity of the assets of the balance sheet into account as well. We need some risk measures which not only measure the bank of an individual bank, the risk of an individual bank, but also how it spills over to the others, some co-VaR instead of a VaR. So you have to take these externalities into account. A clearinghouse arrangement have to be promoted and focus on averages rather than snapshots. And of course, bailouts create moral hazards. And there's many more aspects. I only have a few minutes to talk about some of them, which can be done to improve the current system.
Great. How do we do that? He wants to turn the lights. Could you try to turn these lights off here? Great. All right, great. Well, let me start off by saying with the utmost sincerity and humility that among the people up here, I know the least. I have the least clue of what's going on. Somehow I got invited, and to a panel with Krugman and Blinder. So I said, hey, what the heck? I'll try it. So my task, as assigned by Hyun, was to talk about how we got here and some of the lessons that that we might draw from this. Okay. So Hyun made an analogy in the beginning talking about that we're sort of in this sort of Jackie Chan movie. But in fact, I think my take on the crisis is very much that we're in a bad Bill Murray movie, Groundhog Day, where, if you remember, ever since about a year ago when the subprime crisis hit, each morning you kind of wake up and another bank goes bankrupt, right? And things have really accelerated within the last few weeks, but this has really been going on for the last year. And in fact, I would argue that it's really been going on for a much longer period of time, right? But let me start off with the simple story. I think the really simple story about what's going on is that, we've had a really spectacular housing boom that many economists have warned was reaching kind of bubble territories in the last 4 to 5 years. And last year, basically, housing prices weren't going up anymore. And in fact, they were going down, okay? And it turns out that a lot of the investment banks that have already been mentioned, basically the big five of Wall Street, ended up being caught holding a lot of bad mortgages. Okay, and not only that, but they got caught owning these bad mortgages using a lot of borrowed money. In fact, you would say an insane amount of borrowed money, right? What economists would call very extreme leverage ratios. And so a lot of these banks are basically near insolvent or are insolvent. And as these prices have come down, and interest rates have gone up, and Markus did a great job of talking about the painful process of deleveraging. And I think kind of why we're in Groundhog Day is that, housing prices are just notoriously slow to move. We know this from lots of years of studying empirical data on housing prices. Right? That on the way down, they're very, very slow to move because lots of investors really think their house is terrific. Right? They don't want to sell it for prices that are lower than what they bought it at. So as a result, I think we're kind of experiencing sort of the slow motion crash where, starting about last year, we're getting sort of these crises as the firms that were the most levered up, that held the most mortgages, ended up going down one by one. Okay? Now, you might ask, I'm confused because
how is it that Wall Street, Goldman Sachs and all these guys, who are supposed to do the underwriting of bonds and equity for Main Street, that is GE and GM, end up being a savings and loan, writing and holding a bunch of mortgages for households in Las Vegas, Miami, and San Diego? Okay? And so I think to get an answer to this, I think you have to kind of, the way I think about it is that it's really a continuation, I think, of the dot-com bubble, if you remember. That wasn't so long ago. Right? So these same 5 banks basically made a lot of money during the dot-com era by hyping and also selling a lot of overinflated stocks. And so when the dot-com bubble ended, essentially, even though the Fed dropped rates dramatically, Main Street, wounded basically by the dot-com period, didn't really want to do any more borrowing. Right? And so these firms basically had to come up with a different source of revenue. In other words, to get kind of a higher earnings growth to satisfy, to keep stock prices up. And here basically is where this is obviously the ex-post analysis that we ended up in this environment at the end of 2001 towards 2002, where you had companies basically not wanting to do any borrowing. So there was basically no underwriting bond or equity business for these firms. Okay? But at the same time, there was sort of this political environment of what you call sort of the home ownership society and very, very low rates that led to a creation of sort of the subprime industry. Right? This is basically what I would call kind of the no job, no problem loans that were created during this time. So the banks basically bought a lot of these mortgages from Las Vegas, from Miami, from San Diego, et cetera, and created a security, which is a lot of fancy words. You can call it, mortgage-backed security, but basically you can also call it subprime USA, and started issuing claims on the security, which are called CDOs, or collateralized debt obligations. Right? So essentially, you've got this company, you could call it subprime USA, that has some revenues or claims to it, cash flows from it, that then these firms basically got credit rating agencies to rate, just like any other company like GE, with the AAA tranche for the senior debt. That is the guys that will get paid unless all hell breaks loose. Then, of course, there's the AAA to the BBB guys, and et cetera. Okay? So this is a great business, while it lasted, because essentially during this time when the globe was filled with a lot of liquidity, we were able to sell securities now that, one, you were able to get a lot of guys that had little extra returns, a little extra yield compared to other securities, so lots of people liked it. Moreover, in fact, these guys couldn't really get enough of this business. A lot of them actually went and bought a lot of mortgage origination companies, which was a little bit unknown. So the mortgage origination company, which all all know of, is basically like Countrywide, right? Where essentially they're the guys originating and creating these loans locally. And in fact, what's very interesting is these banks, and I think the big mystery, and perhaps not a mystery, is that they kept the safest AAA tranches for themselves. In other words, on their own books. Now, this was a great trade in some sense because they were still pretty cheap, and it didn't cost much capital because they had a AAA rating, right, from a regulatory perspective. So as a result, that's how you had Wall Street getting, through this process, a significant exposure due to lots of borrowing on subprime. Right. De facto, they ended up being kind of an SNL on steroids, as I think Hyun pointed out. But I think you have to even go back further, I think, to think about kind of all the stuff that's happened, which is, I think, the last 25 years you can basically call, one of the big golden ages of finance. That was, right? And it ended last Sunday, which is, you get a 25-year run of pretty limited regulation in which there was a lot of innovation and a lot of risk-taking. At its peak, which is about a year ago before the subprime crisis hit, financial firms represented 25% of the S&P 500. Okay, now it basically is in the low teens. That's a humongous a share both of market value and also as a fraction of GDP. And I think a lot of economists nowadays, and I think a year ago, started talking about really, is this size of the sector really needed to finance all of the real activities that were going on? And that's a big debate that's going on in economics right now. And among a lot of very smart financial economists is really, was the size that big? Now, maybe the debate is a little moot because, the thing has shrunk really fast, maybe faster than anybody had expected. And I think that the end came basically about a year ago, 2 years ago, really, when the Fed raised rates and kind of the era on a lot of worries about inflation, related to commodity prices, et cetera. And so the cheap credit environment's over, and last Sunday, when Goldman Sachs and Morgan Stanley ended up agreeing to become bank holding companies, really the major investment bank broker era, as we basically know it, and Wall Street is over. So what are some lessons, okay? So I guess lesson one is basically I would say, Toto, we're not in Kansas anymore. These are really strange days that are very difficult to understand. You know, and I think here, I really wanted to extend that. I think, you know, to some extent, we're going to go through a referendum on markets and innovation, and I definitely want to be for those. I think markets and innovation are great things, right? They fuel the tremendous amount of prosperity and growth over the years. But I think also the other thing that we have underappreciated is that to some extent, speculative bubbles and excesses are in the DNA of markets, right? I think particularly of kind of highly innovative and risk-taking societies. You know, I mean, after all, you know, bubbles don't come out of nowhere, right? .com was really great. You know, I mean, I really love YouTube, right? I really love Google. I mean, there was a lot of great innovation that came, and you might argue that, and one of the things that we've learned over the last 10 years of studying bubbles, which is sort of what I do along with a lot of my colleagues at Bendheim, is basically just to think about what are the recipes you need, what are the ingredients you need to get these bubbles started. So I think, you know, the lesson that we've learned is that it's kind of easier in some sense than you think if you have, in fact, kind of a lot of this innovation going on. Because lots of psychologists, like Danny Kahneman here, have taught us that, you know what, lots of investors are very overconfident. They think they know a lot more than they really do, right? Second, as we discovered last week, you know, our society really doesn't like short selling, okay? You know, shorting America is not a good idea, right? And what we show in these models is that a combination of overconfident investors and short selling, it's pretty easy to basically get speculative bubbles started. Right? And it's definitely, if you sprinkle on a little bit of leverage, or a lot of leverage as we had it, right? Certainly, most models, and I think many of the economists in our department, particularly all the macroeconomists who studied this many, many years ago would agree, you know, you can definitely get situations where there are excesses or prices move way too much relative to fundamental value. And in fact, I think if you think about it, you know, given kind of all of these frictions, the smart money is really not to, in some sense, to attack the bubble, but to paraphrase Markus's phrase, is to really to feed the bubble. In this case, basically, Wall Street writing, issuing, supplying a lot of loans to a lot of investors to basically build a lot of homes, right? And if you kind of look at the era of the last 5 years, much of the GDP growth in this country has basically been building homes. Okay, number two, I think not all bubbles are created equal. I think the dot-com gave us a lot of great technology. And in some ways, you know, you might argue maybe that is just a cost for us to kind of really have an innovative society. You know, how do you regulate kind of human behavior? How do you regulate overconfidence? Right? This is the same thing that kind of got you all the good stuff in the first place. Now here, maybe the Fed, I think, perhaps learned the wrong lesson, if you kind of recall kind of all the debates around this time, which is that, you know, perhaps it's easier to basically clean up these bubbles after they've kind of crashed than to kind of prick them while they're on the way up. Right? Assuming you can even figure it out in the first place, which is obviously a very hard task. And of course, hindsight is completely 20/20. But I still think there's a recognition, I think, many economists that, you know, it was there, right? I think, for instance, you know, the Yale economist Robert Shiller has really been kind of calling these things pretty right for a number of years. But I think here the thing we learn is that housing bubbles are in some sense much more dangerous than I think stock bubbles because they're more levered and they sit much more in some sense in the balance sheets of banks that are much more interconnected in the financial system. And I think the one thing we've learned is that it's not so easy, I think, to control a soft landing during the deleveraging process. Number three, I think don't blame the messenger. You know, transparency, one of the things you're reading these days, and especially in the Wall Street Journal, is like transparency is bad, marking the market, having realistic prices is bad, we should make up some fantasy prices for these assets. Short selling is bad because, you know, somehow that's just bad. You know, and I think here, opaqueness, I think, and complexity are the problem, not the other way around, because if you really think about what's going on, it was the short sellers who really called these banks on they're pretty faulty assets. They're bad loans, right? And I think here, you know, the bad regulation, and in fact, I think the other thing is just sort of the bad regulation and the poor governance are also to blame. You know, how did the SEC basically in 2003 allow these investment broker-dealers to go to a 30-to-1 leverage ratio? Did any of us know about it? Not really, right? And, you know, it's not our daily job to pay attention to kind of what's the leverage ratio for these banks. You know, how are the analysts during the dot-com periods also complicit in thinking a lot of hyping of stocks? You know, which was definitely there. That was the whole Spitzer scandal. And how is it that these credit rating agencies ended up issuing so many AAAs? You know, at the peak of the housing period, there were more AAAs than risky security risky securities. Lesson number four, I think, is the past is not equal to the future. I think the big mystery is, you know, how did the smart guys get caught this time? Right? You know, how does the Goldman Sachs and all these guys get caught with this? I think here, I think there's another innovation we have to really think about. It's not so much all these acronyms, but the fact that, you know, quantitative finance has kind of given us the feeling or models that thinks that we've conquered risk, that we understand risk, right? And I think here in these models are a lot of built-in assumptions using past data, right? There's assumptions that were made about why these guys thought that, you know, the AAA tranche of the subprime USA was safe. It was because in the United States, we've never had a major national downturn, at least not in the recent past. So therefore, by averaging Miami, Las Vegas, et cetera, you know, you could pretty much insulate yourself because what you own was really kind of a diversified average of all these things. But here, of course, there was an assumption about the correlation, about kind of the systemic risk that you may not have seen in the past, but of course the past is not equal to the future, right? And I think we see a little bit of this in the LTCM hedge fund crisis of '98. Where again, you know, the refrain was that, wow, you know, our models didn't tell us this. You know, this was not supposed to be possible. Okay? And I think in some sense, you know, and I think here, I mean, I have to be you know, I'm certainly part of this, so I don't say this in sort of a very smug way, you know, since I spent a lot of years teaching derivatives and quantitative models, et cetera, is that, you know, we may know a lot more about hurricanes at this point and earthquakes than we know about financial disasters. And then I think lesson 5 is I think history always repeats itself. You know, I think there's also sort of this refrain in the press that, oh, somehow this is like the storm of the century as if it's never happened. But in fact, it kind of happened in Japan, right? Japan basically at the end, in the mid-'80s, through 30 years of forced savings after World War II, had a tremendous amount of savings. They bought a lot of stocks at in the end of the 80s. After that was over, they bought a lot of housing, right? And so basically by the end of the early 90s, this basically ended. And during this process, right, as we know now ex post, and maybe again hindsight is 2020, you know, there was a lost decade of what's typically called the lost decade, you know, which Paul Krugman has talked a lot about as far as kind of the banks and the government sort of being in denial. So I think in some sense, my take is that one silver lining of all this crisis that has happened is that, you know, the market, I think, at least to some extent, has kind of made the debt overhang problem, right, forced us to deal with the debt overhang problem at a much earlier point. And I think there's models that you could write that would suggest that that's a good thing from the perspective of producing kind of economic growth faster in the short run rather than having sort of a 10-year run. So I'm going to then leave it to Paul and Alan to then tell you how to save the economy. Is it moving? Was it moving, the slides? The slides move. See the slides changing?
Okay, great. All right. So, yeah, so the reason we're having this discussion this week and not 2 weeks ago is not, first of all, that all hell broke loose, and secondly, that Treasury Department said, okay, here's what we want to do, and it's a pretty big thing. So let me talk first, overview, and we haven't actually had any macro, which is fine. Let's just, take the sort of macro overview, and, the starting point for all of this is the housing bust. So I have this, I wrote this in the Times and started places. Think of it as a four-step, four steps to meltdown. So the first is this housing bust. I'll show you a figure on that in a minute. So we had a very high housing prices, a lot of lending, based on the assumption they would just keep going up. And they didn't, and they started coming down, and that means large losses on mortgages. The basic rule is that when house prices are going up, it turns out there is this question: will people just walk away if their house is worth less than their mortgage? There is a website now. There used to be Flip My House. Now there's something called YouWalkAway.com, which asks whether walking away from your house is for you. But there isn't a whole lot of that. But what there is stuff happens. Somebody loses their job, they have big medical expenses that the insurance doesn't cover, whatever. If house prices are going up, they can resell the house and pay off the mortgage, or they can take out a home equity loan to meet the expenses. If house prices are going down, none of that works, so default rates go way up. And that leads to a lot of losses, true losses, not panic selling, not fire sale, true losses on mortgages to whoever lent the money and ultimately to whatever financial instruments have been based on that. Those mortgage losses cut sharply into the capital, the excess of assets over liabilities, if any, of financial institutions, which in turn, these financial institutions play a big role in funneling credit through the economy and plays a big role in the economy. If they don't have the capital, they can't provide the credit. Now, you could say, well, if it's a good business, why doesn't somebody come in and, why don't people start new banks if the existing banks are undercapitalized? And the answer is, yeah, give us a decade or so and that will happen. But in the long run, it'll work out, and in the long run, we are all dead. So that's our immediate problem. And on top of that is all the stuff that Markus was talking about, which is that as institutions are in trouble and they're trying to get out of contracts, they're trying to sell off their assets, there is this process where they themselves are driving down the price of assets, and there is this kind of vicious circle. The paradox of deleveraging is if everybody is trying to reduce the amount of leverage on their balance sheet, they may drive down asset prices so much that they all end up in worse balance sheet shape than before. And this is a kind of maybe it's a self-fulfilling prophecy, maybe not, but it certainly has a big, or has a multiplier effect. I'm not sure how big on the underlying stuff, but there is all this underlying stuff. So, the housing picture. This is, it's the Case-Shiller 10 city. So it's a little exaggerated because these are the 10 biggest cities and house prices moved less in smaller places. But Case-Shiller deflated by the consumer price index. So, oops, I moved up one unintentionally. I'll show you. Real housing prices. Didn't do much for a long time, and you can look, and real house prices have moved much less than you'd think over the very long term until now, until this decade. And then you get this huge increase in housing prices, which miraculously most people, most sensible people said, oh no, there's no bubble, it makes perfect sense. And it's very strange that the bubble denial is, we need some psychology on bubble denial. It's, and sociology and politics, among other things. There was this, I think we had Bill O'Reilly on tape saying that the only reason I said there was a housing bubble was because I hated President Bush. So there's all that. And this is two things. One, huge bubble, so a big problem. And we are not, by any reasonable index, anywhere close to, back where we started. The housing decline is not over. Substantial decline probably still to come. For what it's worth, I just pulled this up at the last minute. It's actually the same index, I think, and there are futures markets. They're not very thick, but there are some, people betting on the future prices on that index. This is on a log scale, and they are showing a substantial nominal decline, another 17% or so, which is, given the time horizon, is more like 25% real terms. So people who are, to the extent there's actually a futures market, people are betting there's a lot of housing decline still to come. This means that there are a lot of losses, underlying losses that you can't, we can't make go away, that are coming. So we can't, there's nothing. I suppose the federal government could go in and buy up 10 million homes and knock them down to drive up housing prices or something. But fundamentally, housing prices are still going to keep falling, large losses. Important paper at Brookings recently by Jan Hatzius of Goldman and others, using a model to try and predict what the mortgage losses are going to be, given alternative scenarios on housing prices. So this is taking into account that effect where falling house prices lead to more defaults, more foreclosures, more losses. Part of the trick here is that when foreclosures take place, the banks don't get much of their money back. They tend to lose something like half the mortgage value when they seize the house and then try to resell it. And these are big numbers. These are billions, obviously. So these are large losses, so far acknowledged by the financial system, something like 480, which means that they're roughly up to what the losses should be if prices were going to stay where they are now, but they're not. So there's more coming, and this has nothing to do with any of the stuff Markus was talking about. This has nothing to do with the panic and the fire sale prices and all of that. This is sort of what's underlying. Okay, so what are we going to do? And so what a week it was last week. We started with, a week ago Sunday, the Treasury Department saying we've no more bailouts. This is the end of the line. Lehman doesn't need to be rescued. Everything will be fine. And by Friday, actually, we're going to do an enormous bailout of everybody and their brother. The phrase that's being used all the time, our former department chairman used it this morning, and it drives me crazy, is what we need to do is we need to take the troubled assets off the financial system's balance sheets, off the balance sheets of financial institutions, clean this up, and then we can return it to health. And that's an extremely evasive phrase. It actually avoids what was the key issue. So I think of just an imaginary financial institution without being too clear about what type it is. And our finance guys will know that that's a classic reference in the name of it, Capital Decimation Partners. That's a paper by Andy Lowe some years back, which has got a balance sheet which has got, it's got debt and it's got assets that's okay stuff and it's got toxic waste. And, taking the toxic waste off the balance sheet is easy. The firm just says, okay, this stuff is worthless. We're going to declare it's no longer on our balance sheet. The problem is that then they're bust. So that doesn't help any. And having the Treasury Department go in and buy the stuff up at, let's say, 20 cents on the dollar so that they get 10 for the 50 of toxic waste still leaves them bust. They can actually sell it. They can do about that. Actually, we've had some offloading of mortgage-backed securities by financial institutions that were in relatively decent shape, and they were getting like 22 cents on the dollar. So they can do that. But the only way that this firm gets helped is if Treasury comes in and buys the stuff up at quite a lot more than that. So it's not taking the troubled assets off the balance sheet isn't the issue. The issue is at what price. And is Treasury planning to go and pay basically way above what current market prices are? Okay. So what is the plan that Hank Paulson, the Treasury Secretary, offered? It's $700 billion purchase of troubled securities. That much we know. What are the mechanisms? On what terms will the stuff be bought? Not explained. Nothing. It's got to be for a $700 billion program. It was a 3-page sheet with no details about how the money would be spent, but it did contain this kind of interesting clause. Decisions by the Secretary pursuant to the authority of this Act are non-reviewable and committed to agency discretion and may not be reviewed by any court of law or any administrative agency. So this is basically the Treasury Secretary can do whatever he feels like, and there can be no second guessing after the fact by anybody, which is really quite extraordinary. I've been trying to come up with language to how to. Part of the problem is even if you believe that Paulson is irreproachable and no problem, the fact of the matter is we have this election coming up, and somebody else is likely to be Treasury Secretary after January 20th. And so if the Republicans win, if McCain wins, whatever they say now, it's probably going to be Phil Gramm. And so the question for Democrats is, do you want Phil Gramm to have this power? And I've been trying to come up with somebody the Democrats might appoint who would be comparably scary to the other side. And so what I came up with this afternoon is what if Obama appoints me as Treasury Secretary? Okay. What are they going to do here? Now, the way it was being described until this morning was, I should say one more thing. Paulson, this morning in testimony, said that, people have been saying that I don't want any oversight. This is not true. I do want oversight. The only reason that it wasn't in there was this had to be a very simple, quick document, and it would have been presumptuous to try to describe an oversight mechanism. But in fact, this clause and there are a couple of others are very carefully designed to rule out any oversight, which I think is kind of telling, because actually this is very important. Actually, let's be serious here. The Secretary of the Treasury is proposing something and went to great lengths to write it so that there is absolutely no oversight and no recourse if people disagree with his decisions. And then this morning said that black is white, that he was doing no such thing, when anybody can take a look. It's only a 3-page document and see that it says nothing. It's exactly the opposite. And this means that any presumption that one might want to give that this is being done in good faith has now got to be put on one side. They've given us no reason to believe that any of this is being done in good faith. Now, what are they planning to do? I think part of the answer is probably they don't actually know, right? This is worth bearing in mind. But as it was described until today, it seemed to be they were saying, well, it's just liquidity. There's no market, and we're going to create a market, and people will be able to sell these assets in a way they couldn't. And there was talk about it being auctioned, which was going to suggest they were actually going to pay market prices. But as of this morning, our former department chairman appeared to say, it was in elliptical language, appeared to be saying that it's not. They're actually going to pay above market prices for these troubled assets, which actually makes sense. If this is our problem, then, and your goal is to essentially recapitalize capital decimation partners so that it can go on doing business, then you've got to pay a premium price for this stuff. You can't sell the toxic waste at what it's going for on the market. You've got to take it off at something close to par value. So this is what Ben said this morning. If the Treasury bids for and then buys assets at a price, okay. Translated, this appears to mean, where it's not quite clear what it means, but it seems to be saying we're going to pay what we think is a fair price given some assumptions about what the thing would be worth. It looks like premium prices. It looks like what they actually are intending to do is to pump capital into the financial system by paying prices for this troubled paper that are much higher than what it's able to sell for now, which looks like a substantial taxpayer risk. And that's it looks like a tremendous gift to the firms involved. So what do we say about that? The way I've been thinking about it is that as the plan is evolving, it's basically calling upon the U.S. government to serve as a white knight, as the guy who comes into a troubled firm and says, okay, look, I can supply you with the cash you need to keep operating. But of course, if someone does that, whether it's a Saudi prince or Bank of America or somebody, they don't do it, just by buying up a stock. It's not a gift. They don't go and buy up a lot of your stuff for what it's more than what it's worth. They come and supply the cash, and they take an ownership stake as well. And the logic seems to be very strongly that if you're going to do this, you need to be seeking you need to be seeking an ownership stake. Now there is actually Senator Chris Dodd has a proposed bill released yesterday, which has a mechanism that basically says that if the federal government ends up having to sell these assets at below the price it paid for them, that translates. There are equity warrants, and it translates into an equity stake, which that seems to make a lot more sense than what's being proposed. I go back to the beginning and say, what is it we're trying to do? Until today, it looked as if they were just trying to deal with step 4. They were just saying, okay, there's a panic in the market, and we're going to try and relieve the panic by buying up this stuff, which always seemed kind of odd because there's still a huge problem even if you do that. What it appears to be is that now they're trying to do step 2. They're trying to bulk up the financial capital of the financial system, which I think is right. If you actually look historically, that's always what happens in a financial crisis. The government always does step in, effectively nationalize part of the financial system, sell off the bad assets, recapitalize it, and keep it going. That's what we ourselves did in the savings and loan crisis. It's what Sweden did in the early 90s. It is ultimately what Japan more or less did. But they're trying to sell us a plan in which all of that is done with no quid pro quo, no government stake, just handing out the money. I I don't think that's going to fly. I hope it doesn't. I think this does need to be done. Financial crises always end with a big government bailout. And we're reaching that point. The only question is whether it's done in a way that gives at least a reasonably good deal for the taxpayer. Thanks.
Okay, so what I'd like to do is to give the panelists a chance to reply, and then we'll open it to the gallery for questions. Oh?
Yeah, and my apologies. I have to run quite shortly because unless the phone call that I got in the middle of this was telling me that something's canceled, I have to go and enlighten a larger audience in a few minutes. Larger, but less well-informed and less intelligent. So I actually want to address just two things quickly. One is what Alan said about urgency. One thing that doesn't get discussed too much is how serious is what's happening in these markets for, like, the real world. One thing we should say is that this credit squeeze that's going on is so far not affected. There are large parts of the economy that are not being affected. Corporations with good financial positions are able to issue bonds. Lots of businesses are still able to get loans. There is starting to be some problems, but and one thing that the general rule about monetary policy, financial policy, is that the place where the rubber meets the road, the place where you really get traction, certainly the place where monetary policy gets traction, is actually in the housing market. It's actually mortgages that really matter. And guess what? We already nationalized the mortgage industry, right? We just took Fannie Mae and Freddie Mac are essentially the mortgage industry right now, and they have already been nationalized, and their debts are already guaranteed by the federal government. So the place where you have the greatest urgency. When I saw the interest rates on conventional 30-year mortgages starting to spike, which they were doing as the crisis around Fannie and Freddie built, that was serious. But they've come down sharply since they were taken over. So that's okay. So there isn't, it would still be, if this thing drags on for 2 months, then I get concerned. But if it goes over, the Friday deadline was supposed to be, well, Congress wants to go into recess because of the Jewish holidays, and this is no basis for deciding what you're going to do about the financial future of the world. So we need to, I think we have time to work this out. Second thing to say is, look, we do have historical precedent. What do we do? What do you do when the financial system is really troubled, or parts of it? And typically what happens is the government takes over the institutions, in effect takes ownership, guarantees their debts, and largely cleans out the existing stockholders and then puts them back together again. We did that effectively with Fannie and Freddie just now. By the way, people have been, one thing here is the Treasury has not yet come up with a name for this thing, although I've been hearing Bailey May being proposed as one. But the
say hanky panky.
Hanky panky, that's a good one. So we did that with Fannie, and one thing that got lost with the speed of events was actually the rescue of AIG was in effect. The government took a 79.9% ownership stake in return for guaranteeing, in effect, the firm's liabilities. That was a good rescue. It got, overrun in the events, but that was the kind of thing we should be doing. And, someone has pointed out that we actually have a lot of experience domestically, internationally with financial rescues, and it's really weird that the current U.S. Treasury is insisting that it's going to do something, a home brew that bears no relationship to the normal practice here. And one of the things that we ought to be doing is actually moving this so that it looks a little bit more like the tried and true remedies for things in the past. And a lot of people are talking about the Swedish model of the early 90s, and I have a little bit of Woody Allen, Bananas, where the revolutionary leader goes mad and says, all right, now everybody's going to speak Swedish. But I think, we can learn a lot here, and let's take a few days to talk this over. And with that, I got to exit. Sorry.
Anyone else?
Let me just follow up on the rush issue. I think there are certain elements you really have to rush and other elements you don't.
You need the mic, Markus.
Right.
Concerning the rush issue, I think there are certain elements you really have to rush and other elements where it's less important. And I think it was a very wise decision to give some guarantee for money market funds. There was really a danger that this huge $1 trillion money market might break down, and this would have got huge repercussions over the whole system. I think that was a very important thing. Let me also follow up on Alan's point on how to auction off. Overall, I think I'm in favor of taking an equity stake rather than going for auction off these mortgages. But what you can do is you can normally you don't auction off individual mortgages, you bundle them together. Of course, there's the issue of adverse selection, but this happens all the time on the mortgage market, that you bundle them in big baskets together and then you auction off the whole basket in order to reduce the adverse selection problems. Of course, you always have the problem there's this cheapest to deliver, so you might deliver the least worth one. But of course, the buying side should be aware of this. Let me then. Harrison mentioned that short selling is actually short sell constraints are a very bad thing. I tend to agree with him. Allowing short sales actually has a very correcting force, and you should actually be able to push prices down and up. But in extraordinary circumstances, I think it should be allowed to restrict short selling to a certain degree. It shouldn't be done in such a rush as it happened, but you can imagine a situation where short sellers drive down the equity of a firm and then induce a bank run. So I haven't heard this argument, but essentially this is especially the case for financial institutions who have this mismatch of maturity very pronounced, so they induce a bank run, and that might be difficult in the current situations. However, in the long run, it's not clear whether we want to put this in place forever, in a sense saying whenever there's a crisis, we restrict short selling, because this will change the incentive ex ante, how much leverage you take and how much mismatch of maturity you will take. So this might be an extraordinary measure this time around, but in the long run, we might not want to do this anymore. With this, I leave it.
Yeah, I guess that in sort of Paul's question of who I would assign to be the Treasury Secretary, I would just basically assign a bankruptcy lawyer. You know, I mean, we have bankruptcies all the time in America. You know, lots of corporations go bankrupt. Lots of guys disagree about value, right? And that's kind of what a bankruptcy lawyer is supposed to do. A bankruptcy judge is supposed to kind of figure this stuff out and kind of we have Chapter 11, get these guys kind of going back healthy again, right? But at the same time, kind of getting all the sides to kind of come together and do stuff. So I think we have more experience than simply just kind of bailing out financial sectors. We have a great model with bankruptcy law in the United States to deal with all these things.
Okay, so why don't we collect some questions? Please wait for the microphone, and then over there. Yeah.
Oh, gosh. I'm a CEO, not a big company like Bear Stearns, but a real small company. And I think I understand my organization. And I actually think Bear Stearns the CEO there probably understood his organization.
Talk louder, because the footsteps are drowning you out.
In listening to their description of how this all started with respect to these long-term maturities and being financed with short-term debt overnight basically, and the risk that implied as this multiple grew larger and larger, is not something in my mind that was hidden to the CEOs and not misunderstood by the CEOs. So the understanding of the risk was indeed there, and it was not ignorance that allowed everybody to be going the same way at the same time. So I'd like to see what your comments are on that, and whether it was something else actually, which is what the guy next door was doing to make his money, and how much profit there was in this, and that the risk was known but disregarded because of the potential profit and the fear of falling behind the guy down the street.
Okay, so let me just paraphrase that question. So you're saying if the firms knew what the risks were and they still went ahead and did it, you want to know what the mechanisms were within the firm that actually allowed this to happen, right? Okay, so let's collect another question, and then we'll take that. Yeah, Kai. Wait for the microphone.
Thanks. I was thinking for $700 billion, you could buy a lot of other things, right? I mean, if you look at the mortgage market, it's 50 million mortgages, and if you assume, 25% of them go underwater, so you would have, whatever, let's say 10 million mortgages that would go under and default and, go into foreclosure. And if the average mortgage is about 200,000, I think, right, or 220,000, I mean, if you were just to create an entity just to prop up all those people, I mean, that actually would be probably a little cheaper than the 700 billion if you assume that you only needed, say, 50% of the mortgage value to prop up the people who would otherwise go into foreclosure. So I was wondering on the issue of, the actual property market, whether or not maybe the 700 billion might be better off propping the property market versus the MBS market.
You got that, right?
Yeah. Let me take the two questions backwards, in backwards order. What you're saying, Kai, is exactly the reason I brought up the two prongs. I mean, the words coming out of Secretary Paulson seem very much geared towards buying up the paper and very little geared to buying up the mortgages and doing or a variety of other things you could do with the mortgages, and I'm not at all convinced that that's the right balance. On the gentleman's question before, if I heard the question right, I think the answer is yes. So, and the question I'm answering yes to is, was the risk management done disgracefully badly? That wasn't exactly what you asked, and my answer is yes. The worst CEO of the year quotation, I wish I could remember the exact words, was Chuck Prince, the now deposed CEO of Citigroup, who said something like, I don't remember the exact words, when the music plays, you have to dance. Leadership, whether it's in a government bureau or university or in a business, is sometimes you don't dance when the music plays.
You want to add something?
I just want to add one little piece to it. Of course, competitive pressures might force you to dance. And I think having a better regulation in place might be helpful to avoid these scenarios. So you have to improve the regulation, takes this into account in order to get rid of the competitive pressures and people just do something knowing that it is bad for the economy.
I have an anecdote, actually. So about 3 years ago, I was at a conference where we had central bankers and private sector participants. And the private sector participants were the ones that were saying, you central bankers, you need to do something to arrest this bubble because we can't help it, because we're just private sector organizations and we have to follow whatever is the competitive pressure. And I think that situation is clearly untenable. So when we go forward, we need to restructure the regulatory system in such a way that, those kinds of incentives will not arise. Time for one more question. So up in the gallery, can we get, okay, can you shout?
Sure, hopefully you hear me. I'm just wondering, if we had done more about the mortgage meltdown, say a year ago, and started bailing out those mortgages then, do you think we would have avoided a lot of this meltdown that's happened on Wall Street now?
I think we would have gotten a lot of the meltdown anyway, but it would have been much less, I believe. I was advocating for an organization, a structure like the Homeowners Loan Corporation, which was part of the New Deal, January, maybe before. January is the first time I can find I actually wrote it down. I don't remember when I first voiced it. And it wasn't just me, by the way. It was not like I invented this idea, hardly. The problem that is well illustrated by the Japanese, and we've illustrated it but on a much shorter time frame, much, much shorter, and that's good. Somebody mentioned this, Harrison, I think, is that the longer you let these problems fester and the bad incentives remain in place, and indeed sometimes worse and go-for-broke incentives start coming on top of the generically bad incentives, the worse it gets. So earlier is better. The trick in earlier is better is that don't make, I never remember which is the type 1 or the type 2 era. Don't start applying Band-Aids when there's no bleeding.
Okay, well, thank you very much for coming. It's been a very enlightening experience. I've certainly learned a lot, and there was an outbreak of consensus there at the end, so we didn't even need to use the fire extinguisher.
No,
Thanks very much.